Money FM 89.3. Best of breakfast. The U.S. Market Update with Money FM 89.3.
Good morning. Welcome to the U.S. Markets Wrap. And we've got U.S. stocks rallying after the latest CPI numbers. The Consumer Price Index report showing core inflation unexpectedly slowed in December. And we also have the latest on the earnings front from major U.S. banks. They kick off their numbers with blowout results. So all in, we've got the Dow Jones Industrial Average up 1.7%. That's about 700 points, closing at 43,221. The S&P 500 up 1.8% to 5,950. And we have the Nasdaq Composite outperforming, rising 2.5%. So it was the best day for all three major averages since November the 6th. Now let's check in with our guest, Vincent Ee. He is the Head of Investments for Asia at Schroders Wealth Management. Vincent, good morning. How are you doing today?
Morning, Ryan. Thank you for having me on the show.
Great having you on. So we have a lot of things on the table to unpack. And out of the news, we also have a headline to get into, which is the ceasefire deal that has just been reached between Hamas as well as the Gaza situation. Israel and Hamas agreeing to a ceasefire deal that will release dozens of hostages and bring a temporary halt to the war in the Gaza Strip. What do you take away from the latest developments? How much will this continue to lift markets where they are right now?
Yeah, we've had a huge session overnight, I think, in markets. Like you mentioned, the CPI was a much anticipated release, and the number came in a bit weaker. Was a bit softer than the consensus estimates. So I think that was taken as a very huge positive. Both equities and bonds rallied, gaining back some of the lost ground recently. And the 10-year bond yield that everyone's watching so closely, yield sank 14 basis points, but they're still at very elevated levels of 465. So right now, I think the markets, they are bringing forward the first Fed rate cut in 2025 to July. Early on, it was September. If you look at the probability of a rate cut right now, I think that's quite low for January. So I think everyone's sort of watching the markets. Overall, we do see the relationship between the Fed's interest rate path, inflation, and Treasury yields influencing the market. In particular, this year, I think the equity markets are growing more sensitive to elevated Treasury yields. So the history suggests that with yields spiking so much since September last year, equities could really struggle to digest these sharp moves in rates. So we're watching the bond markets closely. But for now, I don't think markets are focused on that. Everyone's got quite a bullish sentiment. And as you mentioned, we had a ceasefire announcement between Israel and Hamas. So I think that's lifting sentiment even further. That was one of the tail risks that many investors were watching out for, this Middle East conflict growing and sucking in more countries. So I think that tail risk has diminished. So I think that's a positive day for markets, so market sentiment.
Yeah, I suppose a good start to 2025 in terms of where things could play out. And of course, the earnings coming through from the U.S. banks, painting a pretty good picture as well. Are we expecting another good year from the S&P 500 at least? Because we had two good years coming through from that index. We have returns of some 53%, the best 2 years since 1973.
Yes, I mean, the starting point obviously is quite daunting, but like you mentioned, last night was a big night for U.S. financials. We had blowout results. To me, these show that the U.S. economy is on solid footing. We heard from the large financial bellwethers that investment banking business is seeing strong growth. The expectations are for mergers and acquisitions activity to pick up after a couple of slow years. If you look at the loan officer survey, I think that points to a rebound in loan growth as well this year. And I think the most important thing, I guess, valuations, at least for the financials on a PE basis, that sector is still trading below its long-term historical averages. So all in, I think we like the financial sector because of those multiple tailwinds blowing in its favor. And we also see interesting opportunities, I think, generally outside of the Magnificent Seven companies, which have been gaining a lot of investor interest over the last couple of years.
Yeah, there has been a lot of talk about how we should be looking beyond the Magnificent Seven to the other 493, which is supposed to play catch-up. So on that front, where do you see the opportunities outside of the Mag 7?
Yes, the Max 7, like I said, it's led to the market concentration that we've seen so far. But beyond the Magnificent 7, I think the biggest reason to look there is the rate of change of earnings growth is likely to be faster for those 493 other companies in the S&P 500 compared to the Max 7. The consensus estimates for earnings growth rate in the Max 7 is expected to decelerate from having posted 30% growth over the last 2 years to a more mid to high teens growth rate for this year and next. Whereas the other 493 companies, they didn't grow at all over the last couple of years, and for the coming 2 years, they're expected to grow so low to mid-teens pace. And I think to close that argument, if you look at the PE multiples, the Max 7 stocks continue to trade at a premium multiple of 31 times versus 19 times earnings for the rest of the 493. So at the end of the day, we really have to ask ourselves whether such a large valuation premium is warranted.
Yeah, I suppose part of the story is how everyone's trying to jump on board the AI bandwagon, and of course the Max 7 has a big slice of the action there. How are you approaching investing in this trend, this theme of AI?
Yeah, the tech sector, I think AI, everyone's talking about AI, everyone's talking about technology. So we do like technology. I think the buzz around AI has touched all of us in our daily lives too. And we know that AI goes well beyond the tech sector. So even at Schroders, many of us are using our proprietary generative AI system on a daily basis, and it's redefining the way we work. But outside of the financial firms, we have a multitude of companies across different sectors, healthcare, legal. They all have adopted AI to enhance efficiency as well. But in early stages, the generative AI is estimated to account for only 3 or 4% of total IT spend today, and that's expected to expand to 14 to 16% by 2032. So we really, it's something to watch, and it's something here to stay. But we have to look at AI quite holistically because it's more than just semiconductors. I think areas such as the cloud service providers, data centers, security software, and even power grid infrastructure equipment, they can stand to benefit from the demand both in the US and internationally.
Yeah, a lot more picks and shovels to look at when it comes to the AI theme. All right, talking about things to look at, of course, some things on a calendar that we are watching out for very closely is Donald Trump coming into office. How are you reading into what investors should be taking away and I suppose watching when these transitions take place?
Yes, we have the inauguration coming in less than a week. Donald Trump Part 2 or 2.0 is definitely on the lips of everyone else. And that's been one of the key worries, I think, for many investors. It's about the policy uncertainty and what executive orders is Trump going to implement on day one, what sort of campaign promises he actually delivers on. Those will be wildcards for the market. And in the base case for our economics team, we believe that Trump will have a pro-growth stance. So I think that's going to boost GDP growth to around 2.5% in this year, accelerate further to 2.7% next year. So this should bode well for a risky asset. But I think the question is whether he will deliver on all his campaign promises. And we think that, while he will implement protectionist policies, to what extent and what form, that's very much still in the air. His team of advisors, we think, will be very carefully assessing the real impact of any proposed policies. So we're hopeful that his bark will be louder than his bite.
Well, it's going to be an interesting year to navigate and helping us to plot some of the, I suppose, signposts to watch out for. We've got some help from Vincent Ee. He's the head of investments for Asia at Schroders Wealth Management. Vincent, thanks so much for your time and insights this morning. Have a great day ahead.
Thank you. It's been my pleasure to be on your show. Thanks.
Catch up with us on Money FM 89.3.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance. To listen to more great interviews, download our podcasts at audio.sg or download the audio app. That's AWEDIO, audio at the App Store and Google Play.